The state pension is often spoken of as though it were simple, a fixed amount that arrives reliably once you reach a certain age, nothing more to think about. But I want to tell you something that surprises almost everyone I share it with. The amount that actually lands in your account each week is very often smaller than it should be. Not through any fault of yours, but because of small, easily missed mistakes, buried deep in a system that rarely explains itself clearly. Today I want to walk you through 7 of the most common state pension mistakes, quietly costing UK retirees real money, sometimes thousands of pounds over the years. Number 4 is the one that even people who've done everything else right tend to get wrong, simply because nobody ever tells them about it. So let's go through this together, patiently, because a little time spent here now could be worth a great deal to you later. Before we begin, a word of reassurance. None of what follows is your fault. The state pension system, for all its importance, has never been particularly good at explaining itself, and successive changes over the decades have left a confusing patchwork that even some professionals find difficult to navigate fully. Simply watching this video and checking your own position puts you ahead of a great many people. Let's begin. Number 1. Not checking your national insurance record for gaps. Your state pension amount depends directly on your national insurance contribution record, and you generally need around 35 qualifying years to receive the full amount. Gaps can appear for all sorts of ordinary reasons. Time raising children, before certain credits were properly recorded, years spent caring for a relative, periods of low income or self-employment where contributions weren't quite what they should have been. Even simple administrative errors on the part of an old employer decades ago. I think of a lady named Sandra, a retired nurse, who discovered upon finally checking her record online that 3 years were showing as entirely missing, years she had definitely worked, simply due to a payroll error at a hospital that had long since closed. Correcting it added a genuinely meaningful sum to her weekly pension for the rest of her life. The government's own website lets you check this for free in a matter of minutes, searching simply for Check State Pension Forecast. Please, do this today if you haven't already, whether you're already receiving your pension or still approaching it, because gaps can sometimes still be filled, even after the fact. Sandra told me the whole process, once she finally sat down to do it, took less time than she'd spent worrying about it beforehand. She'd put off checking for nearly 2 years, assuming it would involve some complicated form or a difficult phone call, when in reality, it was simply a matter of logging in with details she already had to hand and looking at a page that laid the whole record out clearly, year by year. What struck her most, she said, was how ordinary the gap looked on the screen. Just 3 unremarkable blank lines among 32 filled ones, easy to miss entirely if you weren't looking specifically for it, and yet worth a genuinely meaningful sum over what she expected to be 20 or more years of retirement. It's worth saying, too, that these gaps are far more common than most people assume, and they rarely reflect anything you did wrong. Time spent caring for children before certain credits were automatically applied, years of low-paid or irregular work, periods spent caring for an elderly relative, even simple clerical errors by employers decades ago. All of these can leave gaps that have nothing whatsoever to do with how hard you worked or how responsibly you managed your affairs. The system holds the record. It rarely holds the full story behind each gap. Only you, checking directly, can supply that missing context and, where appropriate, put it right. Number 2. Not knowing you may be able to buy back missing years. Once you've found a gap, many people assume nothing can be done about it, particularly if it was years ago. But in many cases, you can pay voluntary national insurance contributions to fill gaps, sometimes going back many years further than you'd expect, due to certain transitional arrangements. I recall a gentleman named Peter who found he could fill 4 separate gaps for a total cost of under £1,000, an amount that, once done, increased his pension permanently for the rest of his life, paying itself back within roughly 2 to 3 years, and then continuing to add up every single year after that, for as long as he lived. This isn't right for everyone. Sometimes the sums don't favor it. Sometimes you already have enough qualifying years regardless, which is exactly why it's worth checking your own specific figures rather than assuming either way. But too many people simply never learn this option exists at all and quietly go without money that a modest one-off payment could have secured for the rest of their life. Peter's case is worth explaining a little further because the details matter. He rang the Future Pension Center, a genuinely helpful government service that exists specifically to answer questions like this, and was talked through exactly which years were worth filling and which weren't. Since not every gap is equally worthwhile to close, depending on how many qualifying years you already have. This is an important nuance. Buying back years isn't automatically the right move for everyone, and in some cases, particularly if you already have enough years for the full pension, paying to fill additional gaps would simply be money spent for no extra benefit at all. The value of that phone call wasn't just the information itself, but having someone lay out his specific numbers rather than a generic rule of thumb, which is precisely why a direct conversation about your own record beats any general guidance, including, I should say plainly, the general guidance in this very video. Number 3. Claiming as soon as possible without checking whether deferring suits you better. There is a natural instinct, entirely understandable, to claim your state pension the moment you become eligible. It feels like money owed to you, and in a sense it is. But if you're still working or have other income and don't urgently need it, deferring your state pension increases the amount you'll eventually receive by a meaningful percentage for every year you wait. I knew a lady named Josephine who continued working part-time past her state pension age and deferred claiming for 2 years, resulting in a noticeably higher weekly amount for the rest of her retirement once she did eventually claim it. This isn't the right choice for everyone, particularly if you need the income immediately, or if your health means a longer life isn't something you can bank on with confidence, and that's a genuinely personal calculation only you can make. But too many people claim automatically the moment they're able to, without ever pausing to ask whether waiting might actually serve them better. What made the difference for Josephine wasn't any particular financial sophistication on her part, but simply a conversation with her accountant's son, who pointed out that claiming immediately while she was still earning from part-time work would push some of that pension income into a higher rate of tax, effectively handing back a portion of it before she'd even properly received it. Deferring meant that money instead accumulated as a higher permanent weekly amount, arriving later, but taxed more sensibly once her overall income had settled into retirement. Not everyone has an accountant's son on hand, of course, which is exactly why this is worth raising directly with the pension service or an independent advisor well before you reach state pension age, rather than assuming the automatic path is necessarily the wisest one, simply because it requires no decision at all. Number 4, and this is the one that even people who've done everything else right tend to get wrong, simply because nobody ever tells them about it. Not claiming pension credit, even when they're entitled to it. This is possibly the single most underclaimed benefit in the entire country, and it matters enormously because pension credit doesn't just top up a low income directly. It acts as a gateway to a whole range of other help, including help with council tax, free TV licenses for those over 75, and certain NHS costs. I think of a gentleman named Wilfred, a proud man who assumed pension credit was for people worse off than himself, and was genuinely astonished to discover, when a friend finally persuaded him to check, that he was eligible for a meaningful weekly amount he'd simply never claimed for years. Many people wrongly assume owning their own home or having modest savings automatically disqualifies them, when in fact the actual thresholds are often more generous than people assume. It costs nothing to check, takes perhaps 10 minutes on the phone or online. And the pride that stops so many people from checking is, I promise you, costing them real money they are genuinely entitled to. Number 5, not understanding how the married couples or inherited pension rules might apply to you. If you're widowed, divorced, or in certain other specific circumstances, you may be entitled to inherit or benefit from a portion of a spouse or former spouse's insurance record or state pension, particularly under the older negative 2016 rules that still apply to many people currently retired. I recall a lady named Betty, widowed at 68, who had no idea for over a year that she was entitled to an increase in her own state pension based on her late husband's contribution record, simply because nobody had thought to mention it to her at what was, understandably, an already overwhelming time. These rules are genuinely complicated and vary considerably depending on your exact date of birth and marital history, which is precisely why it's worth a direct conversation with the pension service specifically about your own circumstances, rather than assuming the standard rules necessarily apply to you. Betty's situation, once someone finally explained it properly, turned out to hinge on the precise date she and her late husband had married, and on which side of a particular reform date her own state pension had begun. Details so specific that no general article, including this one, could ever safely tell you exactly how they apply to your own life. What matters is simply knowing that these provisions exist at all, so that if you are widowed, divorced, or have a complicated marital history behind you, you know to ask the specific question directly, rather than assuming, as Betty had, for over a year, that your own pension was already complete and correct exactly as it stood. Divorce brings its own version of this same complexity, and it's worth a brief mention here too. In certain circumstances, pension sharing arrangements made at the time of a divorce, sometimes decades earlier, can affect your state pension entitlement in ways that are easy to forget about entirely by the time you actually reach pension age. I think of a gentleman named Douglas, divorced in his 40s and remarried by his 50s, who had entirely forgotten about a pension sharing order from his first marriage until a routine check revealed it was still affecting his current calculation, for better as it turned out, though it could equally have gone the other way. Old paperwork from decades past has an uncomfortable habit of resurfacing exactly when your pension is calculated, which is one more reason a direct, specific check of your own record matters more than general assumptions ever can. Number 6. Ignoring your pension forecast letter or not updating your details with HMRC and the Pension Service. This sounds almost too simple to matter, but a surprising number of delays and underpayments happen simply because contact details are out of date, meaning important letters about your pension or about changes you need to respond to never actually reach you. I knew a gentleman named Norman who missed an important form entirely because it went to an old address nearly 2 years after he'd moved, resulting in a genuinely frustrating delay sorting out a straightforward increase he was owed. Take 5 minutes today to ensure both HMRC and the Pension Service have your current address and telephone number, and open, rather than set aside, any official-looking letter about your pension the moment it arrives, even if it looks dry and administrative. The dry, administrative-looking ones are usually exactly the ones that matter most. Norman's story had a second layer worth mentioning too. The letter eventually caught up with him. At his new address, a deadline for responding had technically already passed, which meant an extra round of phone calls and a wait of several more weeks simply to have the situation reopened and resolved. He told me afterwards that he'd always assumed important organizations like HMRC would somehow track him down regardless, the way a determined old friend might, when, in reality, they rely entirely on the address you've given them, updated by you, and nothing more sophisticated than that. It's a small, unglamorous task, updating an address with 2 or 3 organizations after a house move, and it sits low on most people's list precisely because nothing bad happens immediately when you forget. The cost only reveals itself later, quietly, in a letter that never arrives, or arrives too late to matter. Number 7. Assuming the system will simply tell you everything you're entitled to, without you ever having to ask. This is, in many ways, the mistake underneath all the others, and the most important one to correct in your own thinking. The state pension system is not designed to proactively chase you down with every extra penny you might be owed. Overwhelmingly, it responds to what you ask for and check, rather than volunteering information freely. I think of a lady named Eleanor, who put it to me rather memorably. I spent my whole working life assuming the pension office knew more about my situation than I did. It turns out, mostly, they only know what I've told them, or what I've thought to ask. That shift in thinking, from passive recipient to active checker, is genuinely the single most valuable mindset you can bring to this entire subject. It helps, I think, to understand why the system works this way, rather than simply feeling frustrated by it. The state pension touches many millions of people, each with a unique working history, marital history, and set of circumstances, and no system, however well designed, can proactively model every individual life and flag every possible entitlement without being asked. This isn't an excuse for a confusing system, and there is a fair argument that it could and should do better. But understanding the reason behind the silence, sheer scale, rather than any deliberate withholding, makes it a little easier to approach with patience rather than anger, and to treat the occasional phone call or form as simply the price of ensuring your own situation gets the individual attention it deserves. Now, let me draw all of this together into a few simple actions worth taking this month, regardless of your current age or circumstances. First, get your state pension forecast checked, whether you're already receiving it or still years away, simply to see the full picture clearly. Second, if you find gaps, ask specifically whether filling them makes financial sense for your situation, rather than assuming either way. Third, if your income is modest, check your eligibility for pension credit properly, rather than assuming you don't qualify. Fourth, if you're widowed or divorced, ask directly and specifically about inherited pension rights, since these are rarely volunteered without a direct question. And fifth, keep your contact details updated and treat every official letter about your pension as worth opening promptly, rather than setting aside for another day. Let me close with Eleanor's story in a little more detail, because I think it captures something important about all of this. After that conversation about the system only knowing what you tell it, she decided to properly review her entire pension situation for the first time in over a decade. She found a gap she was able to fill affordably, discovered she'd been eligible for pension credit for nearly 3 years without claiming it, and realized, once everything was corrected, that her monthly income was measurably higher than it had been the month before, without her having done a single hour of extra work to earn it. It felt, she told me, like finding money I didn't know I'd already earned. That is, in the end, exactly what most of these 7 mistakes represent. Not new money, but money you have already, in fact earned, simply waiting for someone to ask the right question on your behalf. If this spoke to you today, please subscribe, because every week I share these honest, practical lessons for our later years, and I would love to have you along for the next one. And I would genuinely love to know, in the comments, whether checking your own pension forecast today turned up any surprises, good or otherwise, because your experience might be exactly the nudge someone else watching needs to go and check their own. I read every single comment. Take good care of yourself, and I'll see you in the next one.